Hey guys, Drew Haynes here and welcome back to the channel. For you guys that don't know me, I am a real estate investor, entrepreneur from the Midwest. On this channel, we'll go over real estate investing and other ways to make money, not just real estate, other investments too. Today, I want to go over why real estate makes such a good investment, and why it makes more millionaires than anything else out there. Number one, you really can get into real estate without any money. There's many strategies out there for it, like wholesaling, rental arbitrage, subject to, where you can buy houses with no money. I will be making videos on each one of these strategies pretty soon, breaking down each one of them. As some of you guys might know, I bought my very first property with no money, none whatsoever out of my pocket. In fact, at the closing table, they gave me money, and I did not do wholesale. I'll break that down in a later video also, that way you get all the details on it when we got more time. Number two, real estate is one of the best hedges against inflation that I've seen. As you guys all know right now, inflation is out of control. Real estate's one of the best ways to offset inflation. Hyperinflation is what we got going on right now, but even with, I've seen reports that inflation as high as 12% is the real numbers. They're reporting a lot lower on the news, but they're saying that it's the real numbers around 12%. Some of my real estate properties that I have gone up in value roughly 30% in the last 18 months during all this mess. So beginning in 2020, if you went out and bought a $100,000 house, it'd roughly be worth $130,000 right now without any improvements if you had a 30% appreciation. If you would put $100,000 into, say, a CD, which is a certificate of deposit, you would have probably been pretty lucky to get around 2% right now. So at the end of a year, that 2% on that 100 grand, you're looking at $102,000. But here's the kicker. They're saying inflation was 6.2% from October 20th or October 2020 to October 2021. 6.2%, when some are reporting that real inflation was 12.9. But let's be fair and say it was 6.2%. So your $102,000 CD is really only able to buy $95,600 worth of goods. I know that's a little confusing, but basically in October 2020, it would have cost you the $95,600 to what now costs you $102,000 to buy them goods due to inflation. Let's talk about the $100,000 house that we bought that went up 30% due to the high inflation and the high demand in housing. It's worth $130,000 now. And if you bought it right, you should have been cash flowing it several $100s a month each month. And it would still buy $122,000 worth of goods in October 2020. This is why you see a lot of rich people put their money in real estate instead of holding it in cash. Real estate hardly ever goes down in value if you keep up with it. And if it does go down in value, it's normally a very short-term thing. Number three is depreciation. When you own real estate, the government has provided you with many tax advantages and incentives to own real estate. This is the reduction of value of an asset over time due to wear and tear. So the government, in this depreciation, they say your house has a value of 27 and a half years. I don't know where they got that number at, but that's what they say. It's 27 and a half years is what the life of your house is going to be. We all know a house can last a lot longer than that if they're kept up with. So to depreciate the house, it really needs to be a rental property. Can't depreciate the land that the house sits on. Raw land cannot be depreciated. Let's use that $100,000 house again. I like using the $100,000 house as an easy round number for everybody. So for an example, the government will let us depreciate that house of $100,000 over 27 and a half years. So you take the $100,000, divide by 27.5, and that gives you $3,636. So what does this mean? Let's just say you rented the house for X amount of dollars, and after payments and everything, your cash flow was $500 a month. Your yearly income on that house is $6,000 if it stays fully occupied for the 12 months. If that was the only rental you had, the only income you had, your income would be $6,000, but you would get to take the $3,636 off that $6,000. That would reduce your tax burden to $2,364. So you made $6,000 in income and you're only paying taxes on $2,364 in a roundabout way. I'm not an accountant, I'm not a tax attorney. Talk to your attorney or your accountant about this, but this is just trying to show you how depreciation works on a property. So also remember too that there was hyperinflation, so this $100,000 house went up $30,000 in value. What else can you buy that went up $30,000 that the government will give you a huge tax break on and let you depreciate it even though it actually appreciated? If you guys know something, comment down below, because I want to go buy it. Guys, this is how wealth and generational wealth is created. It's by the value going up and not having to pay out a bunch of your profit to taxes. That's how all these big rich people do this. Worst case scenario, if you bought the house the traditional way on real estate investing, you had to put $20,000 down, which is 20% of the $100,000. That's what most banks will want you to put down at first. At the end of the year, you already made $6,000 back on your money, and you only had to pay taxes on $2,364 roughly. And you still have the $30,000 of equity that you can leverage to get more income producing properties, or you could sell the house and take the profit. Just keep in mind too, guys, the tenant is paying down the principal on that note every single month. When they pay your rent and you go make the payment, the principal's getting paid down every month. So just for another example, if we put $20,000 down on this house, we went and financed $80,000. Let's say that we put that on a 15-year note, because that's what I put all my rentals on, is a 15-year note. Let's say that we got 5% interest. That's gonna be pretty common for a investment property. That's a good, easy number. You can get cheaper, someplace a little bit higher, depending on who you're working with, but let's just say 5% interest. If you put that into an amortization calculator and calculate it, took the 12 months off that you held it, it would show the balance at $76,324.98. Take your $130,000, because the $100,000 house appreciated 30%, so now it's worth $130,000. Minus that $76,324.98, and that leaves you with $53,675.02. Now minus your $20,000 that you put down, that leaves you with a $33,675.02 profit. Now add in your $6,000 cash flow that you profited for the year back into that number. You would have made $39,675.02. Not bad, right? Off one $100,000 house. You could pretty much take that money, and if you still had to put 20% down with the banks, you could go pretty much buy two $100,000 houses. Plus you would already have your $20,000 down back from when you sold the first house. So actually you could go buy 3 houses again. And if you did the same deal pretty much, minus the hyperinflation, but you cash flowed it for $500 a month per house, you're looking at $18,000 a year in income now. That's just the very next year. So you 3 times your income. So you guys get the point. You can start very small and make a ton of money really quick. I hope that wasn't too confusing for you guys. I just want to kind of break down some of the benefits of having real estate, the appreciation, the depreciation, the tax advantages stuff, and was just trying to use some easy round numbers to give me an example of how quick you can grow your real estate with a little bit of money. And you don't have to put money down, but this is worst case scenario, and you had to put the 20% down and go through this. You can still grow your portfolio very fast. Just depends on what your end game is. If you're going to be buying $100,000 houses or selling them in a year, sometimes if you have them go up in value that quick, it might be a good idea to sell it, or you can try to leverage the equity so you don't have to sell it. You still have that cash flowing property, and you go buy some other houses and you just use the equity from your first house. We'll break that down in a video too. Another disclaimer, I am not an accountant. I am a real estate investor. I have an accountant that does my taxes. So don't take this all as hard numbers. This is just an example of how this works. So if you guys did like the content, if you would, I appreciate it. Please like and subscribe. Comment down below if you would. We appreciate you guys. See you soon.